Market value versus book value. The balance sheet provides the book value of assets, liabilities, and equity. The items on the balance sheet are valued according to generally accepted accounting principles, commonly called GAAP. These state that assets, liabilities, and equity must be shown on the balance sheet at their historical cost, adjusted for depreciation. So book values are backward-looking measures of value. Assets are carried on the books at what the firms paid for them, no matter how long ago they were purchased or how much they're worth today. Market value is the current price at which the firm's assets, liabilities, and equity can actually be purchased and sold. What we value about an investment asset are the cash payments we expect to receive over a future period of time. Market prices are the market's valuation of the asset's expected future cash flow. So while book values are based on historical costs and are backward-looking, market values are forward-looking. And market prices are always changing because the world is dynamic and expectations for the future are constantly being revised. Therefore, market values will always diverge from their original historical costs, and consequently the book value of assets can bear little relationship to the current market values. Now let's relate this to financial decisions. My parents bought a house outside of Philadelphia in 1962 for $12,000. It would be carried today on the household balance sheet at a book value of $12,000. It has a current market value of about $250,000. Which value is relevant when making financial decisions, such as whether to sell the house or how much my parents can borrow against the equity in the house? Obviously, the market value. Financial decisions are based on market values. This is especially the case for the financial decisions made by firms, because the primary goal of the firm is to maximize the market value of the firm's common stock. Let's look at an example problem. According to GAAP, your firm has equity worth $6 billion, debt worth $4 billion, and assets worth $10 billion. The market values your firm's 100 million shares at $75 per share, and its debt at $5 billion. What's the market value of your firm's assets? These are book values, and so they're irrelevant for the purpose of determining market values in this problem. We can calculate the market value of the firm's equity by multiplying the 100 million shares by $75 per share to get a total market value of $7.5 billion. And we're told the market value of the debt is $5 billion. So our liabilities, $5 billion, and the market value of our equity, $7.5 billion. But we're asked for the market value of our assets. But since assets equal liabilities plus equity, your firm's assets must have a market value of $12.5 billion. The sum of the $5 billion of debt and the $7.5 billion of equity.